Good afternoon, everyone. I am Min Hui from CGS-CIMB Singapore. So, welcome to part one of the webinar series, Rising with the Trends with CGS-CIMB Quantitative Model. So, during the session, if you all have any questions, so feel free to type them out in the chat function, as you can see on your Zoom platform, and we will do our best to answer them later. So, for this series, it is our honor to invite Jake, a market strategist with CGS-CIMB Research, to tune in with us. Jake specializes in technical analysis and advocates a theory of systematic rule-based trading. So his research coverage spans across global macro quantitative strategies, dynamic asset allocation, and behavioral finance, just to name a few. So we believe that with his extensive knowledge, he will be able to provide an insight to the trends of the market. So without further ado, I'll pass my time to Jake.
Hi everyone, thanks Min Hui for introducing, and it's great to know that Jun Chai is online. Jun Chai is one of our prop traders, and good afternoon everyone. Thanks for tuning in today. Because we have a tight schedule, so I'll try to touch on as much as possible regarding the dual momentum models. As you, oh, I haven't started my video. Sorry, I forgot to start my video. Oops. Yeah, as you understand, most of you have been receiving a weekly email that contains spreadsheets of the models on 7 major markets that we cover. And this session is basically a follow-up, or rather to kickstart communicating these models and explaining the methodology behind it, and to better understand how to use it. And of course, to answer any potential questions that you may have, but you did not raise prior to this. And of course, let's start. Okay, is this moving? Okay, let's start with, okay, I'm not going to go through the disclaimer. I will start with what is momentum, how do we do it, and followed by the applications. We won't touch on the model's performance today because I'm still in the midst of calculating them. And of course, what are the possibilities that you can do with it? I don't, this part I'm not going to touch because it's going to be a very lengthy discussion. Right, so what is momentum? All right, momentum is basically grounded in physics. It's actually a very scientific term or lingo that we happily forgot that we steal it from science. Just like, for example, the word inflation. Inflation actually comes from science as well. It's not finance, right? So momentum is grounded in physics, and basically it just means the quantity of motion an object has, right? And of course, the first law of physics, I'm sure all of us have learned some basic science in our school days. And the first law says that the object at rest will stay at rest, and objects in motion will stay in motion unless they're being acted upon by an unbalanced force, right? Law number 2, force is equals to mass multiplied by acceleration. So this is F equal ma, which all of us at some point have learned in school. Law number 3, for every action there's for every action there's always an equal and opposite reaction, right? So this is also grounded in the fact that how we are able to stand on Earth, things like that. Won't go into this; it's very long. Okay, so these are the key logic behind factor investing or factor research. So factors is basically a key driver of risk and return. Like it or not, we are exposed to it every single day, whether we're traders or investors, but we are just not looking at our risk return from a scientific lens, right? We are usually looking at something else and not trying to dissect and attribute what is actually driving the markets or what is driving the stocks out there. So factors are characteristics that help to explain long-term risk and return performance of any asset. And it is well documented in academic research and is also been extensively used in traditional portfolio management, right? What we commonly know as the Morningstar investment style box. I'm sure we've seen it somewhere in our life, right? Value versus growth, large cap versus small cap, right? So all these things are already well embedded in our lives. So, for example, when the markets are bullish, right, pro-cyclical factors like more momentum, value, and size tends to do better as investors are ready to embrace risky assets. And when the markets is feeling defensive due to whatever reason, could be a macro reason, political reason, the markets will tilt to a more bearish tone, and defensive factors like high yield, low volatility, and quality tends to do better when investors or the markets have lower risk appetite. So has got um, this has got market intuition behind it. So, of course, momentum is not just momentum. There is two main different categories of momentum: absolute and relative. Relative is also what a lot of people call cross-sectional momentum, as it measures and compares momentum against its peers, against its own peers, or sector or broader market. Traders typically call this relative strength. We all have used it before, right? So quant funds typically use relative momentum to generate trading signals. And of course, absolute momentum is also what a lot of academics call the time series momentum. It's basically very stock specific momentum. Like, for example, the stock is up 5%, right? We are not comparing it to the broader market, whether the broader market is up 10 or 15%, right? So it's just very stock specific momentum. So a lot of commodity trading advisors in the world, whether in US or globally, typically use absolute momentum to generate trading signals. So what is shown above is basically on the upper half of the chart is the absolute momentum of Boeing in white and S&P 500 in yellow. And of course, in the lower half of the chart is actually the relative momentum of Boeing divided by S&P, plotted in the green line and followed by uh, red dotted 200 days moving average. So you can visually see as a trader, you should logically start to overweight Boeing since the middle of 2016 around here, and turn neutral in mid 2019 around here, and turn negative in early 2020 around here, right? So in 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 quantitative finance, momentum, whether you are using relative or absolute, it's the best performing factor. And of course, if applied correctly, you can increase your returns and your performance, and at the same time reducing any potential downside risk. It's a matter of application. So momentum has been proven to be one of the most robust and best performing sector in trading and investment management. And how do we do it? So most academics and practitioners basically do this. They rank the whole universe according to relative momentum matrix, like for example, the 12 minus 1 month, whether it's price change or total return or some other form of measurement. And they will use this to generate signals to create a long short portfolio to run backtests or to create portfolios in real life. So usually what they'll do is they long the top 10 to 30% and they'll short the bottom 10 to 30%, depending on the size of the universe. And of course, in the middle part, there's 40 to 80% of it you don't touch. So what you do after that is you form the portfolio and you hold the portfolio until the next rebalancing date. Holding period typically ranges from 12 months to 1 month, depending on what's your strategy. But most practitioners use 3 months. The pros of this is it's very easy to score, to rank the scores, and to run back tests. Of course, the cons behind this method would be it's not practical to implement the short leg in the real world, so it's not quite practical, not realistic, and it did not factor in a lot of things like borrowing costs and transaction capacity. Um, and also, a lot of asset managers in the world actually uh, lack the capacity or the mandate to implement the short side of this. But the long only application of this kind of strategy is typically called smart beta. A lot of product manufacturers have been issuing ETFs or mutual funds format to led investors to expose themselves to what they call smart beta. And this is our approach. We built this model to um, with the with the traders in mind, and typically we are looking at swing trading, trend following, directional trading, and even momentum investors. So what we do is deviating from the academic side of it, we engineered a more targeted approach. So this is where we are a little bit different from other screening models or screening strategies out there. Is what we do is we split the universe into two, positive and negative, before applying a statistical model to, oh, sorry, click the wrong one. Yeah. We split the universe into two, positive and negative, before we apply our models to rank um, both the relative, to rank the relative momentum so that we can isolate um, the, the, the momentum in the model, right? So these models blend relative and absolute momentum together, and that's a little bit different from most of the models out there. And oops, in traditional quantitative research, which focus on cross-sectional, which is a relative strength, most traders um, tend to experience, or most strategies tend to experience very sharp or steep drawdowns, especially when the market is down a lot or declining heavily. And they are still selecting stocks that fell relatively less. So they don't really apply absolute momentum in their models. And this, by applying, by applying absolute momentum, we can actually help to reduce and control the downside risk. To incorporate these two forms of momentum, what we do is we take a two-step process. First, we decide on the universe, right? We decide on which country or which exchange, which index components, whether common stocks or let's say ETF if we want. And to control for tradability, we apply two different screens. First is the size. We limit the market cap that we want to trade. Um, and also we apply a liquidity screen. Let's say most of the time I use a 3-month ADV screen. We put a particular threshold because the threshold is it's market specific, so it can be an absolute number or in percentage or percentile that we can determine which market, what number to apply on what market. And we want to avoid micro cap stocks. So that's why im- we implement a liquidity screen and a market cap screen, right? Most of the market cap most of the micro caps are very low volume trading. So even they can be trading hundreds of millions, but in actual notional value, it's very small. So our whole idea is to minimize or to avoid thinly traded stocks, uh, liquid stocks, uh, market cap that we're comfortable with, and before we before we go into the relative, we start with the absolute screen first, right? So relative screening is absolute momentum is very easy to screen because it basically asks you a binary question, either yes or no, right? So in this case, we use last traded price, bigger or smaller than, in this case, 200-day exponential moving average for the positive model or the negative model. So if, let's say, if we are screening for positive momentum, we want price last traded price to be above. If we're screening for negative, we want price to be below 200 days exponential moving average. So that's one. The second screen is whether the 50 has crossed above the 200 days. That means 50 bigger than 200-day EMA, and vice versa for the negative model. So these are the two screens that we implement for the models. And of course, the remaining stocks from this screen will go into a statistical model that calculates the z-score, or also called the standard score, based on 5 relative momentum descriptors. In this case, we're using the 52 weeks high and low, right? High for positive and low for the negative model. 52 weeks price change, 26, 12, and 4 weeks price change. So these are the things that we use to score the relative strength. The raw z-score normally ranges from -3 to +3. So it's a little bit hard to read for most people. So therefore, we normalize it to a scale of 0 to 100, right? So most people are very comfortable with reading from 0 to 100. And after this, we rank the scores based on a descending order so that we can organize them into four different segments or what we call quartiles. And some people prefer to call it baskets or buckets. Right, so this is how the screening model looks like in Bloomberg. Of course, if we have a little bit more time, we can share. We can look at it in the Bloomberg environment. So this is basically what it looks like. It's very boring, black and yellow color. And of course, the benefits of doing this on Bloomberg is, first of all, we're drawing the data from Bloomberg. We don't have to import, export out data to a particular model on a spreadsheet or other environment, right? We can rely on the computing speed of Bloomberg because it's all done on cloud. So the model can calculate hundreds and thousands of stocks with just a click. So it is fast and efficient, and we can screen for more trading ideas compared. Sorry, we can trade. Sorry, we can screen for more trading ideas better and faster than the next guy sitting right next to you. And because of this, we can exploit traditional means, or we can avoid relying on just traditional means on news flow, right? Whether you see on Bloomberg News or Reuters, um, you can have a larger coverage universe compared to relying on human coverage. For example, Xiaomi's recovery move was actually first detected by the model in early part of January, and we sent out the report on the 17th of January this year. Uh, the, the stock was trading around $13. And of course, we can share these ideas generated with fellow colleagues and clients across geographical regions on the Bloomberg environment. And of course, users can see real-time changes and updates to the models if you have any. And we can work with a team of researchers more uh, remotely, and it can even be more scalable in that sense. And ultimately, these goals are uh, mathematical. Sorry, they are basically an objective expression of reality. So, like it or not, if you don't like a stock that is doing very well, it's still there. And of course, last but not least, users will have a better understanding of how this model works because in the environment, you can see what actually goes into the model. This is how the results looks like when we export the results. Sorry, this is how the model looks like when we export the results to a spreadsheet. The final scores are ranked in ascending order in the green color column, and for positive models, it's in green. For negative models, it's in orange. The relative momentum is also color coded. In the middle, you can see there's a fair bit of green and orange and yellow. And of course, depending on the look back period, we have highlighted the different areas, so we can visually gauge whether a stock is in a correction or in a retracement. We also included the gig sector classification in over here, so that um, users can look at it and identify what are the sectors that are relatively strong and in the positive model. So in this case, Hong Kong market is currently still dominated by IT and consumer discretionary, and the negative model in Hong Kong is usually packed with healthcare and communication services names. Sorry. And of course, applications, how someone would interpret these goals. So in the positive model, the first quartile is representing the strongest momentum, and the fourth quartile represents the least strong momentum, positive momentum in the universe. And in the negative model, the first quartile is the weakest momentum, while the fourth quartile actually um, represents the least weak stocks in that universe. So the net aggregate number of stocks being screened out both in the positive and negative models can be used as a gauge of market breadth. So The latest that I screened out in the Hong Kong side is 159 positive versus 142 negative. So you have more or less a sense of how strong is the market. This is a chart from I picked from the first quartile. This this reflects the momentum profile of the names in the first quartile. Notice the front end gradient of the slopes and the price action around the moving averages around here, right? So the moving averages are widely spread out, and the price action is usually far away from the moving average. So stocks in this quartile is ideal for traders, short-term traders typically, with a time frame of trading between 1 to 4 weeks. So this group of stocks exhibit very strong trend and very positive momentum. The second quartile, it's also very strong, right? But you notice the front end gradient of the slopes sometimes are flat, and in this case, price action is in the middle, or has retraced to find support above the 100 days EMA, and is consolidating sideways for its next move. So stocks in this quartile is ideal for traders with a little bit longer time frame because it takes time to play out. But still, it is quite it is still exhibiting quite a strong trend, and it's likely to continue its positive momentum over the next few months. So this is the third quartile momentum profile. Notice how the front end gradient of the slopes is currently negative, and price action is currently retracing to test the 50-day EMAs. So stocks in this quartile is typically ideal for traders with 1 to 3 months time frame, and stocks are typically in a corrective or a retracement phase. So you see a strong trend, but neutral to a negative short-term momentum. Ouch. And this is the momentum profile in the fourth quartile. You can see the gradient of the slopes from left to right are a little bit flatter, and the price action tends to hug around the exponential move, tends to hug around the moving average, and usually will mean revert to the 200 days EMA. So this stocks in this quartile is typically ideal for traders who are a little bit more patient, or traders who are looking for recovery stories, or for investors who don't like to chase runaway price action, as this segment usually exhibit a milder uptrend and moderate positive momentum. So you tend to find stocks that are recovering from a negative trend, or stocks that are in early stage uptrend, or in a major corrective phase. But however, stocks in this quartile typically shows less consistent in short-term performance. So Minghui, do we have enough time to run through the ideas in Bloomberg, or should we do a Q&A for this?
There's only enough time for Q&A.
Yeah, sorry, I I think I spoke a little bit too fast. I was trying to rush for time. Yeah. Sorry, Minghui, you're saying what? Sorry, Minghui.
Yeah. So we only have time for the Q&A. We'll leave that part for the next part of the series.
Okay. Sure. Yeah.
Thank
So
you, Jake, for sharing. So we'll now move on to the Q&A.
yeah.
So once again, if everyone has a question, they can just key in into the chat function in the Zoom platform. So just give a moment for some questions to come in. Okay, let's start with the first question, Jake.
Yeah.
So for the first time, for those with time horizon of 1 month to 3 months, Does one need to monitor the market momentum on a daily basis?
Actually, it depends what kind of traders you are. Um, there's no one size fit all strategy. Usually, I'm more into the quantitative side of it. That means I um, collectively expose myself to a group of stocks, whether in the first quartile, second quartile, or the whole entire universe that I screen out, because I want to reduce the single stock exposure. So basically, it's diversification. So this is what we like to do. Even for trading discretional, sorry, my nose right. Even for trading discretionarily, I would also create a portfolio, usually with a minimum size of 10 to 20 stocks, so that there's enough diversification. And sometimes I would even go to the extent of doing long short myself. Yeah, so it depends because I usually give it a bit of space and room to move because in this case we have already identified a group of stocks. Um, some of it you want to implement immediately. Some of it you may want to put it on watch list and have some GTC orders to work on the market. For example, if the price action is a bit too high from the 20 days moving average, I don't want to chase. I would just keep a GTC order around the 10 or the 20-day moving average. Right, so I'll let it work. When it pulls back to those areas, I'll automatically execute those orders without having to manually watch over it. This is what I like to do, even when I was trading actively for clients as a broker myself last time. So I have a lot of working orders every day, right? So you just keep focusing on what you can do, what you can't do right now, and accumulate and form the portfolio over time. You don't have to do what quants do. You straight away, let's say on this day, you create a basket of stocks and you just hold it until the next rebalancing period. You can start off by having a watch list. In this case, the EQS or the models provide a good way for you to generate ideas and create your own watch list. Oops, sorry. Why is this thing happening? Oh, yeah. Yeah. So that helps you to have a watch list and you implement your ideas and you form the portfolio from day one. And usually what I'll do is I keep a stop loss or GTC stop loss to to make sure that there's enough room to move. I still watch over the portfolio and prices, but I don't freak out when it's like pulling back a bit. So if this answers your question, I give it room to move. Yeah. So because not forgetting that this proven to have positive momentum. So it tends to not move in a single direction every single day. So 2 days up, 1 day down. So you have to give it a bit of buffer. Do I?
Uh,
Yeah.
Next question
Uh,
is regarding whether they can do their own criteria on Bloomberg, like using definition as volume.
yes, they can.
So
Definitely they can. Yeah.
they give an example like so if they want to screen today's Singapore Airlines volume is lower than yesterday's volume, and also how can they screen for spike in volume for any particular stocks?
Yes, you can. Like for example, you can. Okay, let's do something like volume. Right. So you just call up the volume. In this case, let's say um, okay, let's just say 1 day ago must be greater than. Oh, sorry. You can do this average volume, right? So you can do like let's just say 3 months. For example, you can say the last 3 months of trading volume must be greater than a particular number, absolute number, or let's say a percentile of. Yeah, there are many ways to play this, right? So you can create your rule. Um, this essentially are a lot of mathematical operators, right? You can say between a particular amount say 100,000 to 1 million. Oh, sorry.
Hi, Jack.
Yep.
Yeah, Oscar here. I'm actually asking this question. So, is that has to be an absolute value? Can I
No,
do a percentage?
yes, you can. Like for example, all this mathematical expression, you can say bigger equals to, in between, not equals to, between.
Uh-huh.
Yeah.
But okay, because it shows that the daily volume over 3 months, right? So Bloomberg itself will calculate the
That's
average
correct.
volume, and
That's right.
then if we do a criteria of greater than the average daily volume, it should be showing the spike in volume, right?
Okay, for example, you can use a percentile over here. It can be, okay, what you can do is bigger than, okay, volume. Okay, let's just say 1 day ago, the volume must be bigger than, uh, okay, let's say percentile of, okay, I need to redefine the rule again. How do I do it? Uh, okay, can I get back to you on this? Right.
Yeah,
But
yeah, yeah. Sure.
volume is not a good way. Usually, what I do is I use I use turnover. Okay, because volume you will go into the area of small cap or micro cap, right? Because your volume
What's
is
the difference between that and volume?
okay. In Bloomberg, they call it turnover. Um, volume is just the absolute number of shares being traded. So your micro caps or your smaller cap shares would have a higher volume, right? Stocks with higher value tends to have lower volume. So turnover or ADV, average daily traded value, not volume, it's basically number of shares times the price. So therefore you get the notional value, right? So like for example, I would prefer to use turnover or traded value for stocks. In this case, let's say you use something like here. There are many ways to define what you're looking for as well. Period over period growth or the trend is the trend. In this case, the average value bigger than let's say a particular um, look back period you're looking for. So this okay, this would have to go. We will have to go back to the drawing board to ask ourselves a more specific question how we want to define this, and therefore we can come back here and create the rule. Yeah. So let's say in this case, just simply put it your traded value or the ADV for yesterday is bigger or equals than let's say a particular period. I will have to figure out a way to define this. So essentially, you're using these two to write a mathematical expression, right? It's quite similar to you writing on the whiteboard or the blackboard. Yeah. So using all these tools here, you can express it in a mathematical format. Like for example, let's say we do this. Where's the scoring model? Scoring model. Okay, let's say you pick a scoring model, or maybe it's okay. You look at um, oh sorry, stuff. Okay, you click on formula. You can create your own customized formula over here. Yeah, so these are some of the customized formulas I created. So if let's say for whatever reason the the mathematical expression is not found or not able to do it on Bloomberg or not doing in the default format, we can actually write it over here, right? So let's say this, you click on this. Um, the formula I created was 50-day EMA bigger than 200 days. Yeah, so you can write it if you cannot find it. Let's say, I wrote something over here. Right. Oh gosh, I got so many formulas. Okay. Yeah. So in this case, you can maybe use something like that. Okay. Just find adjusted volumes, right? What's the volume? So, okay, let's say for example, looking at this, I've got a customized formula, 3 months price change in percentage. It's divided by your annualized volatility, right? Your 3 months volatility, right? So this contains some of the field names that they will draw the data from within Bloomberg. Yeah. So there are many different stuff you can do on Bloomberg. Yeah. Right. So let me get back to you on your. I think I need to get your specifics, right? Because you need to define how long you want your look back period to be, right? And
Okay.
whether in volume or in value traded, or you want to look, yeah, correct.
Yeah. Can I drop you an email later, maybe?
Yeah, but bearing in mind, volume alone is not good enough, right? You need to incorporate price change as well.
Okay.
Okay. Maybe you can like take that at the back. So let's just move on to like for one final
Yeah.
question. So there's a question asking if they want to build a long-term portfolio with a weekly rebalancing feature. Should they just use the top 20 stocks in the first quarter, or what would you suggest?
Um, okay. Generally, these models are created for trading, short to medium term trading. For investors or for long term portfolio, we don't. Okay, when I understand your long term portfolio, I I would I would think you are trying to say you create a portfolio and hold it for 6 months, 12 months, or beyond, right? I hope I'm not getting it wrong. It's more from an investing angle. Um, this needs a different approach. You can't just let's say long the top 20 names um, in the first quartile, or let's say whatever quartile you choose to decide. We need to look at a strategy on its own, right? Not just sticking, because these models are basically idea generation model, uh, give you idea or give you input, right? How you want to define your portfolio, it goes down to your portfolio construction and your time frame. What are you looking at, and are you trying to incorporate some fundamental inputs as well, right? If you're purely based on, let's say, technical inputs, in this case price, then you are exposed, potentially exposing yourself to a lot of volatility. Can you take it? This is some other questions when it comes to creating a portfolio, especially you talk about long term. Then maybe you want to address that. But of course, long term can also mean a long term, short term trading portfolio. That means you want to maintain a portfolio going forward, rebalancing once a week or once a month. Those are the questions we have to address. Whether do you have the right tools to do it, and is your trading cost low enough for you to implement those ideas? For most of the brokers, I think your trading cost is very low. For traders, um, trading cost is very low. So high frequency, high turnover is not a problem. If we are talking about long-term investment portfolio, high turnover is a drag on your performance. That's not advisable as well. So, are you able to share with me offline what you intend to do? Yeah. So, Ming Hui, can you take down who asked the question, and maybe we can talk about it later on.
Sure.
Yeah.
Okay. So with that, we'll end the session for today. So please look out for the part two series of the CQM momentum, which will be scheduled on 25th November, which is next week on 12:30 p.m. same time. So thank you, Jake, and thank you everyone for joining us today.
Yeah, thank you everyone
Thank
for
you. Have a
joining
good
us today.
day.
Any questions, please drop me an email or call me. I'm sure all of you have my numbers, right? We can discuss this and help you to create maybe customized strategies or guide you on how to better construct a trading portfolio out of these models. Yeah. Thank you very much.
Perfect.
Thank you.
Thank you.
Thank you.
Thank you. Bye. Thank you so much, Ming Hui. Thank you guys for tuning in today. We are into the session two or second half of the previous session to follow up on where we have left behind. Okay, so last week we have touched about what is momentum and how we do it. And this week we will touch on the applications, logging into Bloomberg, and of course we will run through the performance of the models since beginning of the year. Okay, I'll skip this part. Okay, so how do we interpret the scores? In the first part of the series, I've actually mentioned it, but this is a very important concept, so I would want to reiterate this point. In the positive model, the first quartile represents the strongest momentum, while the fourth quartile represents the most, or rather moderate, strong names that we find in the universe. And in the negative model, we see, or we sort the first quartile as the weakest momentum, and the fourth quartile to be the least moderately weak quartile. So long only traders should focus on stocks within the first or within the positive momentum universe and avoid names in the negative momentum universe. So stocks with very strong trend or positive momentum, you'll find that they hardly trades or corrects below the 50-day EMA. So traders with no existing positions should try to target a potential entry when it pulls back to near your 20 or 50 days exponential moving average. And you should refrain from chasing price action. And when price action is trading below the 50 days, further correction is highly probable. And of course, traders should consider delaying entry, observe if it holds above the 100 and 200 days EMA during the corrective process. The net aggregate number of stocks being screened out in both the positive and negative models can be used as a gauge for market breadth as well. So in this case, I just generated the Shanghai market breadth. I find 341 names in the positive model and 139 names in the negative model. So this will give us a good feel of or good sense of where the market is doing. Is still in a bullish state, right? So moving on, when you load the models, you typically find names in the first quartile generally to be quite strong. So this is the momentum profile you usually observe in the first quartile, and you'll notice the front end gradient of the slopes and the price action trading strongly above the moving averages. So names in this quartile is ideal for traders with 1 to 4 weeks of time frame as a bit very strong trend and positive momentum. This is the second quartile momentum profile. You'll find that front end gradient it's a little bit more flat, and the price action retraced to find support, in this case above the 100-day exponential moving average, and is consolidating sideways for its next move. So stocks in this quartile is ideal for traders with a little bit longer time frame, typically in the 1 to 3 months time frame, and tends to continue its trend going forward. And this is the profile for the third quartile. Same thing, you find that it's relatively strong as well. This retracement is testing the 50-day EMA, of course, with the premise that it doesn't break, the trend will likely consolidate and move on. Right, so this is the fourth quartile, and typically you find names that are relatively or moderately strong, but in a less steep slope. So this is our basis of measuring momentum. Stocks in this quartile is typically more ideal for longer term traders or investors who don't like to chase price action. And you find stocks in this quartile to be likely recovering from negative trend or in early stage uptrend, or either that stocks that are in a major corrective phase. However, the performance of this quartile is typically less consistent and generally not so strong later on when I show you the performance that I've tabulated. Right, so logging into Bloomberg. Right, so I've logged into my Bloomberg now. So to go to the function, you just type EQS on the top left-hand corner. Right, so I'm at the EQS function. You go to the lower part of this left-hand column, and you look for popular screens. You click on more screens. So you come to this particular tab or page, and you click on share screen. Right, so currently I have one person sharing a screen with me, and I'm sharing all these screens with others. Right. So in this case, of course, I can't click on my own stuff here. I can only show you that these are the screens. For your case, you would click on any of the names being reflected here. So if let's say I've shared with you all the models, then you should be able to see all the models here, and you click on these screens. Like in this case, when you click on the screen, you will see there are 6 options here, right? You can either view them, edit them, run the screen, send the screen to someone else. You can see who the screen is being shared with. And you can also generate reports, right? Generate report and analyze securities. Okay, so I can't click on this one because I want to show you what the Chinese models have in this case. Okay, in this case, because it's my terminal, so I have to do this. Okay, so in order for me to run the Shanghai model, I'll click on this, and in this case, I will view the screen first. So when you are at this page, it's back to the EQS function. So you will see all these rules being spelled out. So these are the building blocks of the model. Right. So if let's say there are certain rules that you want to see or define, see how the rules are being defined, you can click on this. Right, and you see these are the things that you can add or remove. In this case, for example, this part is where I screen for the absolute momentum, right? So the rules are, it must be above 200 days exponential moving average over here. And this 50 days must be bigger than 200 days exponential moving average. So for the scoring model that I talked about last week, you can right click on this And this is where it will show you the models, but you can right click, right click. Okay, yeah, I can right click, edit criteria. Oops, wait. Right, in this case, because I have a lot of scoring models, so I have to manually click them. Yeah, so this is where the scoring model is built, and you can click on this to see what's inside edit model. And these are the things that I've instructed the model to do. Right, and bearing in mind this is proprietary, so uh, please do not overly share this with your clients or um, play with this. Uh, of course, you can duplicate this model. Nothing wrong with that, but um, yeah, please keep it confidential. Okay. Okay. So this is a scoring model, and of course, last but not least, you want to know the results, right? So to see and generate the results, you click See Results. Okay, so this is the generated results. In this case, the whole universe is split into 4 quartiles, right? Of course, if let's say you're doing your own strategy, you can split them into deciles um, or any kind of format you want to arrange them in. For my case, I just want them in 4 different buckets or quartiles, right? So this is how it looks like. Um, it's quite boring. It's just your typical Bloomberg color, black and orange. So the benefits of doing this on Bloomberg is you can draw data on Bloomberg, and the computing speed is quite fast, right? Just by clicking on the model, you can generate ideas from hundreds, even up to 1,000, up to a few thousands. You can, right? There is, of course, limitation. Usually, they will stop at 3,000, or they will try to restrict you at 3,000 results. And of course, you can screen for trading ideas faster and better than relying on traditional means. For example, the Xiaomi recovery was actually detected earlier part of this year in January, right? So users can see these changes in real time if you frequently log into Bloomberg. And of course, you can share these ideas. Um, let's say, for example, you click on this Shanghai Bright. It's the first name in the first quartile. So this is the strongest name within this universe, right? You can click and drop. The good thing about this is on Bloomberg, you can do a quick click and drop analysis. So you can analyze and eyeball a lot of stocks by doing this, right? Of course, you've got to call up the chart function, which is G, right? Of course, I have my own charting format. You can do up your own, crop the charting format and just click and drop, right? So it's very easy and very fast for you to eyeball ideas that you want to look at. And of course, there are some uh, unique names, like for example, this name has been down trading and it just gap up. So these are the ones that make it to the first quartile, and also it warrants your attention because it's breaking out in this manner, right? So let's say, for example, we go to the second quartile. You see, the Chinese universe is really huge. You can, yeah, you can really uh, do a lot of diversification in trading the Chinese markets. Like in this case, the first name in the second quartile is this stock called ENN, Ecological, right? So this is one of the names that you should focus on trading. Of course, not an immediate entry, but wait for a pullback, right? So there are plenty of choices, a lot of ideas, a lot of names to trade in the Chinese market. You see the name in the third quartile, first name Ningbo Joyson, right? These are typical signs of early stage movement, right? Of course, we look at the first name in the fourth quartile, right? I don't even know what the hell is this stock, China Miheco. right? But it is displaying positive momentum. So this the screening model generates and throws out a lot of ideas for traders. So let's just take a look at the last name in the positive model, and you can see this is a relatively um, flat name, and it can potentially break up or down, right? So you can see that the different quartiles really buckets out different names, or sorry, different strength in terms of momentum. Right, so this is a positive model. Let's take a look at the negative model. China. Right, so you just click, and a couple of seconds later, the results will be churned out. Right, in this case, you notice I run screen. I did not view screen. I'm instructing Bloomberg to run the model. Okay, so we have 139 names in this negative model. The first name, let's take a look. Easy Sight. Right, so this is a name that is downtrending. Right, even in the last 3 months, you see it's very weak. So therefore, it's the first name in the first quartile of the negative model. As you as you scroll down, you find, like in this case, the first ranking name in the second quartile is Bank of Communications, right? It's not difficult to tell that this is a downtrending stock. It's a name that you should avoid for long only traders, but it's definitely one of the names that you can consider on taking short trades. Or either that, if you're an investor, avoid these names because it is struggling for momentum right now. So in the third quartile, you see Bank of Beijing, right? Negative momentum, negative trend. Not a good idea to long these stocks now. The fourth quartile, of course, is the least weak names that you should pay attention to. If let's say you are traders who like to do the recovery type of trades, this first name is called China Firm. You can see the trend is relatively weak, but uh, not that not that disastrous. Let's take a look at the last name in the last quartile, Orient Group. Orient Group. Yeah. So you can see actually this name is, if you take point to point, it's in a positive trend. And what is happening right now is it make a recovery. It rallied to a high of 550 and it break below the 200 days exponential moving average. That's the reason why it's in this particular universe, right? So until it recovers, otherwise this name will remain in this universe. If it can recover and show signs of recovery, it will pop back into the positive universe. So this is a good way of filtering out the positive and the negatives. And of course, I believe not everyone has access to Bloomberg, right? So that's the reason why we actually um, export all these results out into the Excel spreadsheet that you receive every week. Let me just change this. Right, so this is the weekly report that you receive. It's in an Excel format, and we color coded this spreadsheet to make reading easier. Right, so the momentum score is found in this J column in the report, and is ranked in descending order. So the strongest stock being on top and the weakest stock below. Right, so the score is also color coded for the positive model in green, right, and is color coded orange in the negative model. And you can see this relative momentum, your 52 weeks, 26 weeks, are all color coded to give you a good quick glimpse of how strong it is. Like for example, if I were to look at this razor, you can see the front end of the 4 weeks, this part, it's 10% within the top 10. Right? Yeah, so this is the least strongest stocks within this bucket, and it could potentially be an entry signal, right? Because it's not in parabolic state. Sorry, let's just move back. Right. Not forgetting that this gig sector is also included, both in Bloomberg and an Excel spreadsheet to give you a feel of what are the sectors that are relatively stronger. Like in this case, Hong Kong is dominated by IT and consumer discretionary, and of course, in the Shanghai is also dominated by consumer discretionary. You can see all these names are being found in the top quartile of the positive model. Right. So this is a glimpse of the negative model. You can see the easy side is over here. You can see that the relative strength is very negative, very red, and these are the sectors that are that not doing that well compared to the positive model, and you find a lot of consumer staples, real estates, and financial names. Right. So this could give you a good gauge of which sectors are having relative strength. And of course, just to sum up the performance, year-to-date performance since the beginning of the year, we started sharing these models with brokers and clients in January officially. So this is the performance of the first quartile. So this performance over here excludes transaction costs, right? So to calculate the performance, what I did is basically I used the signals generated on every first Friday of the month, and based on the stocks being screened out in the first quartile, we form an equal weighted portfolio on the first Friday of the month, and we rebalance this portfolio on the on the first Friday of every month. So it's a monthly rebalancing equal weight portfolio, and performance gross of transaction cost is 50.9% against a benchmark of HSCI of 0.5%. And this chart shows the second quartile. So basically, I'm repeating the process. I'm forming a portfolio on the second quartile signals, and for the past 11 months, this is the performance 32% against 0.5% of the HSCI. This is the third quartile performance. We see that the third quartile slightly outperformed the second quartile, and is having a 39% against a 0.64% of the HSCI. Okay, bearing in mind this could be the 0.6 difference between the previous HSCI could be mark to market calculation, right? So all these are not that critical, right? So essentially, you are trying to find outperformance or against the benchmark. So this is the fourth quartile. As expected, forming a portfolio based on the fourth quartile and rebalancing every month, this is the average performance you get, 22%. You'll find that if, let's say, you less off transaction costs, and if there's any slippage or market impact, any inconsistency in doing this, you may find the performance to be different. So that means the fourth quartile, like what I said earlier, it's a little bit not that strong and consistent compared to the first, second, and third quartile. Right. So what happened is, if let's say you want to mix and match, so I've also calculated the performance of combining the first and second quartile. This means what I'm doing is I'm forming a portfolio based on the first and second quartile names being screened out, and I rebalance it once a month until now. So this is 44% against the benchmark of 0.5%. And this is a combination of the first and the third quartile. You get a performance of 56% against 0.5%. So by By this result, we can conclude that the first and second, third quartile, that means the first three quartiles, exhibit stronger relative performance compared to the fourth quartile. So traders may want to pay attention to the upper end of the model and not neglecting the third quartile as well. So fourth quartile, yes and no, it can throw out some good ideas as well, but it's not that consistent, right? So of course, the big question is why am I doing this, or why the firm is doing this? Because we want to help to improve the efficiency and profitability of traders and brokers and clients, right? We also want to provide some market perspective, identify the market strength and rotation, and generate more trading ideas, either long or short, right? From working with traders for so long, I believe most of us are quite long only, but of course there are some guys who are open to shorting the market. So this will come in handy for you to generate short ideas, right? So of course we can help brokers to manage the client trading exposure by giving them more ideas so that the clients are not trading in concentrated names or in concentrated positions. So by providing more ideas, we're helping the brokers to elevate this problem. And of course, we can identify potential investment ideas for momentum investors. And at the same time, we can improve the risk management because at the end of the day, we want to diversify the portfolio and not having concentration in our positions. And last but not least, of course, these models are essentially engineered for swing trading, trend followers, and directional traders. Not This is not exactly engineered for investors, but we can fine tune the parameters to suit investors, right? Of course, we can even do a multi-factor model to help investors to do stock selection. In fact, this is what we've been doing for the firm as well over the last uh, year or so. We've been creating quite a fair bit of quantitative investment models for private wealth, and of course, these models are um, not only available to them. You can find them in Novum. We have shared these models on Novum as well. So if you have any questions, or if you have any specific requirements, you may want to create something of your own, feel free to approach us, me or Ben. Um, we can always um, find something that find some good ideas and build something for let's say for yourself, right? I've done that for one of the Malaysian top brokers, and he's using this momentum models to trade and getting very good results. Yeah. So I'm open for questions. Ming Hui.
Okay, thank you, Jake, for the wonderful demonstration. So now move to the Q&A. So if you all haven't had the time to key in your questions, please do so. Just give some time for the questions to come in.
Oh,
We can start with the first question, Jake.
mm-hmm.
So one of them is they're asking what do the score of each stock represent? For example, if a stock with a score of 60 and a score of 40.
Well, naturally, the one with a score of 60 is stronger than 40. Yeah. So, like in this case, let's say we are looking at the negative model, right? So a score of, okay, sorry, score is over here.
I'm going to show.
Yeah. Just let me share screen.
Mm.
Right. So, for example, I'm in the negative model, looking at the Chinese markets. In this case, the Shanghai Composite Index. So my top name is this easy site. Okay, trading at $8.69. Let me just move this over. Right. So you can see that it's displaying negative momentum. It has the highest score, and you can move down to find something in the range of 60. Okay, let's just pick something around here. Yeah, you can see. Can you see the relative difference in the score? So a lower score means it's less weak comparatively within the universe, right? If let's say I move it down and let's say we go to 40, 40, 40 happens to be in the fourth quartile. So this a lower score means less negative in a nutshell. So I'll to pick this and track. You see, this name is not as negative as the first name that I've shown. Yeah. So basically, it's calculating strength, momentum strength, or you can call it trend strength, based on what you decide to include in your universe. Yeah. Right. So does that answer the question?
So yeah, so it's just
Yeah,
for if it's in the positive momentum, then it will just be totally opposite
that's right. That's right. It's a mirror
for the
image.
story. Yeah.
Mm, correct. I can show you the positive model.
Then next. Oh yeah. Okay.
Yeah, it shouldn't take you more than a while. In this case, let's say we have a first name Shanghai Bright, right? It's a semicon name, and the score is usually in the 90s. Yeah. So this is a very strong name. Yeah. So even though it's strong right now, you expect a pullback, right? You see, it's far from the moving average. It will pull back. Then it will continue trending far from
Yes.
moving average. It rallies and it mean reverts. This is what we typically call mean reversion. So a good way to find an entry would be you target around here or here, right? Until the trend ends, right? Everyone in the world wants to find where the trend stops or when the trend reverts. Of course, there are other signs or other methods of doing this. Uh, but of course, bearing in mind, whenever it's still strong, it may continue to be stronger. But of course, usually I don't just focus on one name. I always encourage people to focus on the portfolio. That means you have a bunch of names that you can help to diversify your risk, especially when it's, let's say, you're doing quantitative trading. Because, like in this case, if I decide to form a portfolio right now based on this name, based on the strength, I will have a long entry. So it may not be the optimum entry for a quant portfolio, but for the discretionary trader, you can always find these ideas uh, in the model and you add them to the watch list. You can put on an alert to tell you that when the stock comes back to near the 20 days or the 50 days, be prepared to take a long position, right? You can even put a GTC order based on all these numbers over here. Like for example, the 50 days is 152, right? Let's just project it up a little bit. Maybe it's 154, 155. You put a GTC order there. When it corrects to those level, you accumulate positions, right? So, but this is a generic strategy I'm talking about. That means you spot something, you want to wait for a mean reversion to load up. That's possible, or you can do something like what we do in a quant way. You load up and you rebalance the portfolio either 1 week or 1 month down the road. So the whole idea is portfolio management, portfolio trading, portfolio investing. Yeah, it's not single stock. But these models can help you to generate single stock names to trade as well, right? So we're not stopping people. In fact, we're trying to help people by throwing up more names rather than just relying on uh, analysts or relying on news flow. Let's say you see something on Bloomberg, then it suddenly generate an interest. No, this is a systematic way of finding ideas, good ideas to trade long and short. Yeah, correct.
The next question. Um, you're saying that the names are equal weighted. So how many names are kept in the portfolio?
It depends. Like for example,
Yeah.
yeah, for example, like the Chinese markets, I've yet to tabulate the performance yet. But if in this case, theoretically, we were to form a portfolio right now, I want to do a first quartile portfolio. I'll be exposed to, in this case, 86 names, right? Of course, you may argue that yes, it's not practical for a lot of people. Yes, but we can do sampling, right? If let's say you have capacity constraint, you want to do sampling. That means you want to pick random or alternate names. Let's say first, third, fifth, seventh, or either that you take uh, some part of it in the upper end of the first quartile, middle part, and the lower part, right? You may want to mix and match. Or either that you can use this as a idea generation. Like for example, you see these Chinese names. Some of them are quite. Uh, I would say this takes leadership to some of the names that you find in Hong Kong, because a lot of these names are found in Hong Kong as dual listed or H listed, Hong Kong listed, right? So you can use this as idea generation because they are usually taking the lead. The reason why certain names or Chinese names in Hong Kong listed, Hong Kong listed non names that are having Chinese parentage, you find that their movement is actually mirroring the parent in China, right? Like Costco, they're doing exactly the same thing. Sunny Heavy, same as well, right? It's having positive momentum, and that's why the Hong Kong listed name Sunny is also um, experiencing a positive momentum. Like for example, some of the names you find very familiar names. Um, Qingdao, okay, not this. Sinotrend, okay. Do we have any? Okay, like for example, Qingdao, right? So the China listed Qingdao is doing very well, and so is the Hong Kong listed ones. Yeah. So in this case, applying the recommended strategy I put up. Let's say you identify a name um, at some point, like in this case, Qingdao, right? You can tell that this is a positive name, right? Positive momentum, positive trend. I'll be waiting for a mean reversion to here or here to make entry, or either that 100 days, right? So the discretionary part is very much left to the individual trader, how you want to engage your entry and exit, right? But the key thing is to find names that are moving in the right direction. Yeah.
So, next question is,
Mm.
what is the backtest return for the last 5 years using this model?
Naturally, it's good. I wouldn't want to show you the back test anymore because every time everyone show you a back test is likely going to be good. So that's the reason why um, in this most recent results, year-to-date results I'm showing you is what we call out of sample. Right? Out of sample basically means you have do whatever back test you want to do, whether it's the last 5, 10, 20, 30 years. It can show you fantastic results. But until you start chopping off the period and say, look, I'm no longer taking this as the testing period, but as the live period. Right? So what we do is we stop at last year, and beginning of this year, we treat it as out of sample, and we take it as these models have went live, right? So, but bearing in mind, these models are input. That means is idea generation model that feeds into something else, because for a complete strategy, you need an idea generation and also the portfolio construction part, right? So this portfolio construction part consists of some of the rules that I mentioned earlier. When you decide to form a portfolio, how do you weight the portfolio? How long do you rebalance the portfolio? Things like that. For the discretionary traders, it's very hard to determine because you make decisions um, in a unsystematic format, because you may want to wait for entry when it pulls back to 20 days. It can be a 50 days. So we cannot do back tests on that. Yeah. So that part, the discretionary part, is harder to determine. But from the systematic um, way of forming a portfolio, this momentum models typically give you an average return of around 40% in the first two quartiles, the average, and the lower part of the model, that means your third and the fourth quartile, typically give you below 40%. on the average, because let's say I would sum up the third and the fourth quartile, you average out, it's below 40%. So it's in the range of 30 to 40%. Yeah. So these are the back tested results. And over the last 12, coming 12 months, it is also exhibiting the same similar performance. So that is quite safe to say the models are working fine. Yeah. So during back test, it's robust. When we implement it, it's fairly robust. In a market decline, all models will face a drawdown. There is almost no models in the world that you can find that would not face a drawdown. It's a matter of how much drawdown compared to the index or compared to whatever you use to reference, and how fast it can recover. Yeah. At the end of the day,
Okay.
trading is about consistency in generating ideas, um, and your consistency in money management. That means your risk management. How do you mitigate your risk? Yeah. All traders will face drawdown at some point. Yeah, but it's whether do you have a
Yeah.
model or do you have a strategy to make sure that you're consistent enough to do whatever the signals generated to tell you, hey, it's time to be back in the market again. Yeah, so that is something that we are trying to help uh, traders and brokers to formulate. Yeah, correct. So in the but back to the original question. In the Hong Kong model, the average names is about 40 over names, because over the last 12 months we see about between 100 to 160 names in the positive model. So if you take quartile by quartile, it's on average about 40 names. Shanghai, because it's a bigger market, yeah, Shanghai is a bigger market. So average we have about 60 to 80 names in every quartile. Yeah, so it's it's good for the quants because quants like diversification, but it's a little bit harder for individual traders because you need to spread out your bets, right? But I would still advise
Mm.
people to spread your bets between 10 to 12 names, right? 10 to 15 names on the average. That gives you quite a fair bit of diversification, right? And ideally, you spread it across different sectors that are showing relative strength.
Mhm.
Hmm. Yeah,
Okay.
yeah.
So we just have one final question.
Hmm.
So about after taking up a position, is there a way to determine when to close the position?
Well, there are hundreds of ways to do it, right? For the quantitative model, you typically say you rebalance. Rebalance um, generally means if the name is still in the model, right? That means the name is still found in the model or the signal generated next month. If it's still yes, we will keep the name. This idea is very similar to trend following, right? If you are a trend follower, even though you're not exactly systematic, what you do is you hold on to a position until um, your signal tells you it's time to get out. And in terms of discretionary
Mhm.
trading, whether you're trend following or swing trader, you would have a way of determining. For example, what I like to do is I look at the last 4 weeks of low. If I'm trading, I make an entry of a stock. Let's say, let's say I make an entry at $10, right? What happens is if I'm holding a position and move on for, it continue moving for weeks and months, I will hold on to the position until it tells me that, okay, the last 4 weeks low, it's let's say at $15. At any point in time, if it breaks below that 4 week low, I would start closing my position. Uh, that strategy
Mhm.
part, you can really be creative. That means you can do staggering out, or you can immediately close off your position. Yeah. So that strategy part is something
Mm.
very unique to individuals. Um, you would first identify yourself what kind of psychological strength you have by holding on to winners and cutting losers fast, right? And on top
Mhm.
of that, how willing you are to hold on to winners, because some guys cannot wait to take profits. Are you those type?
Yeah.
Yeah. So I cannot give you a generic answer, but we can
Mhm.
tailor different strategy to your different strength in terms of your psychology and your ability to take the swings, right? So I like to use 4 weeks. Some guys can take 2 weeks, right? Let's say your 2 weeks low is at a particular absolute number. If the minute it starts trading below it, cut it, right? Take profits and move on. Or either that, I also like to use moving averages. For example, I let a position move. If it starts trading below, let's say 50 days EMA on the close, right? The next day I would chop off my position, right? Chop off means you can take profits, you can start cutting down. Let's say you have a 10,000 shares position, you take profit by offloading half of it first, and you wait for another half or another signal, or you can totally get out. It's up to you, depending how big you trade, right? So there's no hard and fast rule. You need to come up with a strategy. Even without coding it, you can write it down and you follow it religiously. You'll find that your performance will be more um, uh, consistent, right? By following rules, yeah, you will find your performance improve and overall P&L to improve as well, because you have a clear cut direction what to do when this thing happens. Yep. Okay. So hope
So
that I answered your question.
that's all for the
Mm.
answer.
Yeah. In fact, there are
That
plenty
will
of
be
ways.
all. So we'll end the session.
Okay. Great. Yeah. And yeah, you can use the
We'll end the
ATR as
session for
well.
today.
Yeah.
Mm,
Yeah. So there are many ways to
okay.
determine whether it's time to take profit or reversal signal. You can use the ATR. You can use the Bollinger Band. Yeah. It's really up to you.
Depends on the individual.
Yeah.
Yeah.
Correct. Yeah. There's no hard and fast rule. In fact, I don't like everyone to use the same strategy because you'll find crowding effect. Right? Because everybody use the same strategy. Yeah. It becomes crowded. You will have problem implementing it. Yeah. So I don't subscribe to those one size fits all strategy. Yep. It doesn't work. Trust me,
Okay.
it
So
doesn't work.
that's all.
Yep. Okay. Thank you everyone for
We
tuning
will
in.
end. Thank
Yep.
you. Thank you, Jake.
Thank you.
Thank you everyone for
Bye-bye.
joining. Have a
Yep.
great day. Hey,
Bye.
everybody.
Okay. Bye.
Thank you. Bye bye.